Hello, my name is Clive Corcoran, and what I want to consider in this short video is something that I have discussed at greater length on my YouTube channel, the Corcoran Codex. And the subject has to do with what are increasingly being seen as tremors in the shadow banking system. In case you're not familiar with the terminology here, the shadow banking system is really a term used to describe those parts of the financial system or the financial economy that are not essentially part of the mainstream. We are, in talking about shadow banking, really looking at companies, say, in the world of private credit, private equity, hedge funds, alternative asset management funds, infrastructure funds, and that type of thing. And what is becoming more evident in the shadow banking system are signs of increasing strain, tremors, however you want to describe it. So let me then turn to this, which is an article from the New York Times Deal Book, which is a very good newsletter published by the NYSE. And the headline is this private credit's canary in the coal mine? And what they've said is that steep declines in the shares of private lenders, in other words, private credit firms, after a major fund changed how investors can withdraw money, have sparked worries about more trouble to come. In other words, the idea of the canary in the coal mine. So this involves a company called Blue Owl Capital, which is actually a private lender or private credit firm, which lends money to small, medium-sized businesses. And it operates a number of funds, one of which is focused on the retail market. And the problem essentially arises because there is a kind of gotcha within this fund, an illusion, which is that the loans which the company makes, which are long-dated assets, can then be matched against the short-term liabilities, in other words, the shares of this fund, which are sold to retail investors. If the investors, the retail investors, want to redeem their shares, this creates a liquidity crunch. And then Blue Owl Capital is faced with the problem that in order to meet the redemption requests, it might have to start selling loans. And if there's not a robust market for those loans, this creates a liquidity crunch. What the fund has done is to impose restrictions on the retail investors being able to redeem their shares, in other words, sell them. And if you find this kind of material interesting, could I suggest you visit my YouTube channel, the Corcoran Codex? There, in fact, is the URL.